Hello, I'm Zach Smith, and today we're going to be talking about Chapter 10 from the Economics of Money, Banking, and Financial Markets textbook, talking about economic analysis of financial regulation. The first thing we're going to talk about is why there's this need for this financial regulation. Really the main reason arose late 1800s, early 1900s were because of bank panics. So bank panics happen after an adverse shock to the financial system. One or a number of banks would fail. Depositors would see this and rush to their respective banks and withdraw their money in case this shock to the financial system was affecting their bank as well. Since banks are first come first serve establishments and they don't keep 100% reserves on hand, they would end up running out of cash and become insolvent. So even though the bank was stable to begin with, this asymmetric information of people thinking that they're in danger or their money is in danger when it may or may not be, this caused them to run to the banks and respectively make them fail. So this bank panics made the need for the financial regulations arise, and the FDIC was created. So the idea was with the FDIC is insurance, deposit insurance, up to $250,000 today. It was much less back when it was created. But the idea is that it would short-circuit bank failures and the contagion effect, which is systemic bank failures. Because of this money would be federally insured, so depositors wouldn't have this incentive to go screaming down to the bank and pull all their money out, because they'll know they'll still have access to it if the bank fails or not, through the federal government or the bank itself. And it was quite effective in the 30s. They have two methods they can use when a bank fails. The payoff method is where the FDIC allows the bank to fail, and they liquidate all of their assets and supplement the money with FDIC insurance premium funds gained by the FDIC, and then pay back the depositors. The second option is the purchase and assumption method. This is where the FDIC reorganizes the bank and finds a merger, another financial institution, to take over that financial institution's failed assets. What happens in this situation, though, is the FDIC usually has to buy the weakest loans of the failed bank in order to give that incentive for this financial institution to take on these bad assets. This is typically more expensive for the FDIC to do than the payoff method. And lastly, we have another form of government safety net, and that's the lender of last resort. So when a financial institution is failing and they need an infusion of capital, there's not a lot of banks that are going to be willing to lend to this financial institution that's struggling just to keep their head above water. So the central bank, the Fed in our case, would act as a lender of last resort and be able to offer that influx of cash for the failing bank in order to give them a shot at getting back on their feet when no other banks would be willing to make that kind of lending. Next, we're going to talk about some of the downsides of having a government safety net. So the idea of moral hazard, it has everything to do with risk. So if a bank or financial institution wants to go more risky in their investments, then if there's a payoff, if it pays off, then they gain that much more money for the riskier investments. But if it doesn't pay off, then with the existence of a government safety net, the government's responsible for the losses if the bank fails, and not the bank itself. So this it incentivizes these banks for making these risky investments, basically because the potential for making a lot of money is high, and there is no potential for losing everything because the FDIC will step in and absorb the losses on behalf of the taxpayers and the creditors if it's failed. So this increases the risky activity of these banks. Also, there's adverse selection. The book uses the example of having a bad driver purchasing car insurance. So a bad driver is more likely to purchase car insurance, or in this idea it's FDIC deposit insurance. But they're more likely. A bad driver is more likely to purchase that insurance if they know they're riskier and more likely to have to use it. So this, we can see this come into play where you see riskier investors purchasing this insurance and utilizing it more than some of the less risky and safer, more stable financial institutions. We've also got the idea that depositors have little reason to monitor their financial institutions. Before the government safety net, they'd have to monitor their banks to make sure that their banks aren't making too risky of investments, and if they were, they'd have to withdraw their money. That was their way of influencing the bank's decisions on how they would invest their money, and it was more like a check and balance system. But now, with the formation of a government safety net, that incentive is gone because they know they're going to get their money one way or another, and there's not that incentive to monitor their financial institutions, or at least there's very little to monitor because they just don't have that much to lose. We've also got the idea of a financial institution being too big to fail. This is where, even if they're not federally insured, they're not insured through the FDIC, that the government still guarantees that they'll take action if the institution fails, just because they're too big and interconnected, that letting them fail is not an option. We saw this in 2008 in the financial collapse, but basically this increases moral hazard as well, because all banks have to do, or financial institutions have to do, is become big enough and interconnected enough that to a point where the government doesn't have a choice whether they can act or not when the financial institution fails. So the riskier they go, they know that they're guaranteed through the federal government, and those losses just aren't an incentive to keep them balanced. So now that we've looked at some of the consequences of having a government safety net, we're now going to look at the next few slides some of the strategies that the government can use to regulate the financial institutions, and more specifically banks, in order to counteract some of these negative effects. So the first one we're going to talk about is restrictions on asset holdings. For banks especially, this is strict because this is just the government's way of having some oversight into how risky the investments are that a bank is making. So some regulations are going to promote diversification. They'll do this through dollar value limits that a bank can lend to certain types of loans or to certain individuals in order to cut down or at least minimize some of the more risky investment practices. Also, they're going to prohibit holdings of common stock for banks, just because this is an incredibly risky investment, and to prohibit this would help solidify and stabilize the bank as a whole, and just not give them that option to use moral hazard to increase these investments in common stock. Another way for the government to regulate financial institutions is through capital requirements. Now, when talking about stability of a financial system, the more capital, the better. And capital requirements are setting minimum values for these capital according to the bank's investments and loans that they've made. Capital does two things. It acts like a cushion for when there's adverse effects to the system, and it can absorb those shocks of these adverse shocks and give the bank an opportunity to bounce back and recover, instead of just having that adverse shock and instantly failing and having to be taken over by the FDIC. It also gives the banks more to lose and incentivizes their less risky behaviors, because if there's that much more capital, there's that much more for the bank to lose themselves, and they're depending less upon the FDIC for the minimal shocks instead of just for the major shocks, which is a good thing. So we can talk about the minimum leverage ratio for banks. The leverage ratio is just the capital divided by the total assets. Total capital divided by total assets of a bank. And we can, in calculating this, if it's 5% or more, a bank can be categorized as well capitalized. Anything as the percentage falls from 5%, there are going to be more and more restrictions put on that bank because due to their capital requirements, they are at a higher risk of failing when there's an adverse effect in the system. Now the Basel Accord basically takes this ratio and gives each asset, it weights each asset compared to the risk of the asset. So if there are 4 sections, and the riskier investments are going to require more capital, and the less riskier investments are going to require a smaller amount of capital. It just weights it compared to risk, so that a government security, which is less risky, does not have require the same capital as a private or corporate loan, which is much more risky. Now, one of the bad parts about this is that we can get results. Some of it will result in regulatory arbitrage. Regulatory arbitrage occurs when companies and banks will place their more risky investments of a category, let's say low and high credit ratings for a corporate loan, like the example in the book uses. They'll put the more risky ones in that category on their books, while they will take the less risky investments of that same section off their books, and this will offset the ratio and decrease the amount of capital required, which actually incentivizes more risky behavior, thus resulting in the opposite of what the Basel Accord was going for. Next, we're going to talk about financial supervision, which consists of chartering and examination on the part of the government for banks. Chartering is where, when a new bank or financial institution is being created, they have to submit a proposal to the state or national level, depending on what kind of bank they're opening, detailing like their plan of action, projected earnings, and basically in deep detail all their business plans for this new bank or financial institution they're opening. This way that the government can screen these applications to make sure that they're not dishonest people. They can filter through the people and make sure that only honest people are opening these financial institutions, and they're not being opened by potential criminals or overly speculative individuals who are after their own personal gain. Also, another way that the government can supervise is through examinations. These can be scheduled or unscheduled, and it's basically an assessment of the bank, and it's got 6 major parts to it. The acronym is a CAMEL rating, and which is capital adequacy, asset quality, management, earnings, liquidity, and sensitivity to market risk. And with these 6 parts, they can formulate one numerical CAMEL rating. And with this, the government oversight has a lot of options. If it's an overly low CAMEL rating, they can implement more restrictions and regulations. They can declare the bank a problem bank, and it will be subject to more frequent examinations. They can also be forced to disband the whole bank altogether if they feel like dishonest practices have been utilized, or if the bank just has such a low CAMEL rating that it's barely functioning as it is. So these examinations are a great way to assess the bank as a whole and really give that extra layer of protection and oversight for the depositors at that bank. Banks are also subject to filing periodic call reports, just to reduce the manpower it takes to examine every bank in the nation. So these call reports are usually on a quarterly basis, and they'll be used to assess the CAMEL rating of the banks on a quarterly basis. While financial supervision through examination is a useful tool, it only offers a brief glimpse into the bank's portfolio at that time. With the use of assessment of risk management, though, we can take a look at their management practices and get an idea of how risky or not risky their management practices are. This is because in the modern day financial system, the balance sheets are going to be changing at such a rapid rate that just a brief glimpse it could show that they're riskier than they normally are or not as risky as they normally are. So through the use of assessment of risk management, we can take a look at their management practices and see generally, are their practices risky or not. So the 4 parts of risk management that we can look at are quality of oversight provided, adequacy of policies and limits for all risky activities, quality of the risk measurement and monitoring systems, and adequacy of internal controls. And based on these, we can kind of get a gauge for how the company operates and the type of decisions it's likely to make, and if those decisions are risky or not, and that we can combine that with the Camel score in order to get a better, more accurate overall idea of the riskiness of a bank. Another way that the government regulates financial institutions and banks is through restrictions on competition. Now, the idea behind this is that the more competition there is, the less profits that can go around to these financial institutions and banks, and therefore the more moral hazard incentives that have the potential of being used by these banks. So these banks want to reach their formal level of profitability, and so they will be more likely to take more risks in order to reach that point. Now, the Glass-Steagall Act of 1999 protects banks by making it illegal for other financial institutions who aren't banks to participate in banking activities. Now, that decreases banking competition for banks in the hopes that it would decrease moral hazard, but it also has some disadvantages. It leads to higher consumer charges and decreased efficiency, because those are 2 aspects that will be decreased by competition. If there's only one bank in the town, then they're going to be able to charge whatever they want for their services. So the less competition there is, the higher the consumers charged. But ideally, the less moral hazard is taken by the banks themselves. So now that we've looked at some of the positives and negatives of banking regulations, now let's take that and apply it to a specific example, the savings and loan banking crisis from the 1980s. So to set the stage, in the 1980s, we were coming off of the Vietnam War, and we had very high inflation rates, both from the Johnson's great programs and the Vietnam War. So this was starting to cause high inflation rates, and the Fed, to counteract this, doubled the interest rates that they offered. So we had doubled interest rates, which made it really, really difficult for savings and loan companies, which were primarily holders of fixed interest rate mortgages, which, I mean, obviously you can't change the interest rate on that, so they really greatly devalued and basically took out their whole portfolio of most savings and loan companies. So this made their companies insolvent, but the federal payout for their insurance, they had the Federal Savings and Loans insurance. So that insurance payout to pay for liquidating or merging these many, many insolvent savings and loans companies was too expensive. So what the government decided to do was, instead of taking the actions from the insurance companies that they needed to, they decided to deregulate the savings and loans and hope that they would grow their way out of this bad situation that they were in. So what we had was the Depository Institutions Deregulation and Monetary Control Act of 1980, and this greatly reduced the regulation and supervision on the savings and loans companies on their lending. There was also an increased deposit insurance. The deposit insurance increased from 40,000 to 100,000 that was covered by the federal government. So this greatly increased moral hazard. They had that much. If it more than doubles, it doubled in half. There's that much less incentive for them to have discipline in their actions and using the less risky lending and investing habits that they had been regulated to before. So what this deregulation and increase in moral hazard did was it allowed these savings and loan companies to make riskier and riskier investments with more and more money. In the end, when the investment companies finally crashed completely, the price tag was incredibly higher at the end after all the risky trading they had done than it would have been at the beginning to just pay out the insurance for the insolvent savings and loan companies when they were first became insolvent. Instead, these companies resorted to riskier and riskier practices, including fraud, and basically played the Hail Mary trying to get themselves to right the ship, and it failed. And so the price tag then passed on to the American taxpayers was exponentially larger than it would have been to just pay out with the insurance companies to pay out the insolvent savings and loan companies. And several of the heads of these savings and loan companies went to prison for fraud because of the decreased regulation and just the room to maneuver that they had without the supervision that they had before. In order to recover from the savings and loan crisis, there were two key pieces of legislation that were put into law, one in 1989 and one in 91. The first one was the Financial Institutions Reform, Regulatory, and Enforcement Act of 1989. This created several oversight boards to increase supervision of savings and loans and what's called thrift companies. It replaced the FSLIC, which was the insurance, federal insurance for those, with the Saving Association Insurance Fund, which is under the control of the FDIC. It also added minimum capital standards and raised premiums. It mandated diversity in the portfolio and required a 30% limit of portfolios not be in mortgages for savings and loan companies, which was really the detriment was when the insurance rates increased. So much of their portfolios was fixed rate, low interest mortgages that they were just instantly insolvent companies. Then we have the Federal Deposit Insurance Corporation and Improvement Act of 1991, which was put in place that the FDIC could borrow from the Treasury Department directly. It increased capital minimums again and mandated premium assessments be risk-based. It also was the bailout, and it cost $150 billion to the taxpayers, which is 3% of the GDP of the company, which is quite large. In looking back at the savings and loan crisis of the 1980s, there are several different trains of thought that can be studied to look at the cause of this crisis. If you were talking to a Keynesian, you may say that the crisis was due to the deregulation of the savings and loans, that the insurance companies didn't want to pay out, the federal insurance didn't have the money to pay out for the insolvent savings and loan companies the first time, so they took the easy way out and deregulated, and that lack of regulation is what got us into the mess in the first place. But if you talk to an Austrian economist, then they might say that the presence of regulation in the first place, or the Fed's manipulation of the interest rate, could have led to it. The savings and loan wouldn't have become insolvent if the interest rate hadn't have doubled, and if inflation hadn't have skyrocketed from neoliberal economic policies. Did the existence of regulation pin these behaviors down to a point that when it was lifted that they were bound to swing in the opposite direction? So that's more of an Austrian view on it. And then there's a third third part of it, which is the fraud of the situation, which obviously isn't supported by Keynesian or Austrian economics, but it definitely played a factor in this, and if legality had been strictly followed, there might have been a different outcome. So, in my opinion, it would be a combination of the three things. I think they all contributed to the crisis, and you can't pin it all on one reason or the other. But there's definitely very divergent views of thinking on this, and each is supported with data and statistics that, is not wrong and is proven to be correct. So there's just three different ways of thinking that I wanted to bring up and kind of explore a little bit. But that's the savings loan crisis and the benefits and some of the strategies used to uh, negate the negative effects of financial regulation.